In a video a month ago, I predicted that the AI bubble was set to burst in 2025. The DeepSeek news has only strengthened my view. The most important takeaway from DeepSeek is not the prowess of Chinese innovation, but the fact that AI lends itself to copy. What does this mean for the US stock market, US rates, and the US dollar? What lessons can we learn from the bursting of the dot-com bubble? What should you be doing with your money right now? The history of the human race is a story of technological advancement and conquest. 40,000 years ago, our African ancestors, the Homo sapiens, arrived in Europe with bows and arrows, the first projectile weapon in history, and made mincemeat out of the spear-wielding Neanderthals. 5,000 years ago, the invention of the chariot enabled the ancient Egyptians and Assyrians in their conquest. 2,000 years ago, advancement in Roman metallurgy by making iron weapons such as the gladius stronger, sharper, and more resilient helped the Roman legions defeat larger armies in their conquest of much of Europe, North Africa, and the Middle East. 1,000 years ago, Mongol cavalry archers, riding hands-free using the stirrups first invented in China, went on to conquer the largest contiguous empire in history. 250 years ago, the Industrial Revolution, with its technological and military advancements, helped Britain to subjugate and rule over 23% of the world's population. Innovate, or die, or copy. Spies sent by the US government to Europe to steal industrial secrets in the late 18th and early 19th century laid the foundation of the industrialization of the United States. Japan's journey to become an industrial powerhouse after World War II began with reverse engineering American products like cars and TVs. The Asian tigers, like South Korea, got their starts from copying Japanese technologies. In much the same way, the technological leap of China over the past 20 years wouldn't have been possible without copying technologies and pursuing a policy of requiring technology transfer from Western companies as a condition for doing business in China. Technology is power. It's always been, and it will always be. And the stakes have never been higher as now. The US economy is 26% of world GDP, but its stock market accounts for 63% of the market capitalization of the world stock market. This is because US companies are on the whole more profitable than their foreign competitors, and their earnings grow faster. 4 out of the 5 most profitable companies in the world are US companies. What makes these companies so profitable? Technology and competition. It is no coincidence that the most profitable US companies today are technology companies. Tech companies tend to enjoy higher gross margins. This is because their marginal costs tend to be lower than in other industries. This is especially the case once they become dominant. Windows is 74% of the market for operating systems, Google 90% of search, and Apple sells 57% of the smartphones sold in the US. Dominance is self-perpetuating. In technology, big means you can spend more money on research and development to keep out the competition. It is no surprise that US companies lead the world in terms of spending on R&D. But R&D is not the only source of the market power of these companies. A 2020 report by the House Judiciary Committee accused these companies of wielding their dominance in ways that erode entrepreneurship, degrade Americans' privacy online, and undermine the vibrancy of the free and diverse press. The report suggested that the tech monopolies are not only stifling competition, but that they're stifling innovation itself. Concerns about the anti-competitive behavior of the big tech is about the only bipartisan concern in the US. Under both the Trump and Biden administrations, the FTC and the Justice Department launched major antitrust lawsuits accusing Silicon Valley giants of holding illegal monopolies. Yet very little has actually been done by Washington to rein in their monopoly power. One reason is that these companies have become major political donors and transform their market power into political power. Another reason has to do with the fear of the rise of China. In August, a federal court sided with the Biden administration and declared Google to be an illegal monopoly. One of the remedies demanded by the Justice Department was breaking up the company. Asked about the case before the elections, Trump warned that breaking up companies can be a very dangerous thing because the United States did not want to lose out to China on having great tech companies. America's fears of its tech monopolies has been soothed by its fear of being surpassed by China. These days, many people in Washington view the tech monopolies as America's saviors and think they should be protected. The biggest potential winners of the new rules on exporting AI chips introduced by Biden in his last week in office are cloud service providers like Microsoft, Amazon, and Google. What should we expect from Trump 2.0? Will the US manage to maintain its leadership in innovation? And what does it mean for the outlook for interest rates and the US dollar? One of the defining features of the US economy over the past 3 years has been the decoupling between financial conditions and the level of interest rates. Real yields on 10-year US government bonds have risen to their 20-year high. All else equal, this should have tightened financial conditions. But yet, financial conditions have been easing steadily since 2022 and currently are at levels associated with zero interest rates and quantitative easing. The fact that financial conditions are so easy is why the Federal Reserve is not under pressure like other central banks to cut interest rates. This is why the US dollar has been so strong. So how do we explain why financial conditions are so easy? Simple. The increase in expected return on capital has boosted US equity valuation. But what has been driving this increase in the expected return on capital? AI, of course. Until now, the US has been the clear leader in AI in terms of both innovation and adoption. The fact that US equities have massively outperformed non-US equities and the US dollar has done so well is because investors see the US as being the primary beneficiary of AI. Put differently, AI is why US equity valuation, US real yields, and the US dollar are so high in both absolute and relative terms. The DeepSeek news last week took the market by surprise. But following a sharp drop in tech stocks, NASDAQ has bounced back. Can it be that DeepSeek will prove to be just a little dip on the path to total US technology domination in the age of AI? Monopolies are protected by high barriers to entry. In the tech sector, this often has to do with the fact that big innovation is expensive and only few companies can afford it. The DeepSeek news last week ran in the face of the supposition that the barriers to entry in AI are high. The fact that DeepSeek, a Chinese startup founded only 4 months ago, is capable of building an AI model that can boast of similar performance of OpenAI is not necessarily proof of great innovation. What it does prove is that the technology lends itself to copy. DeepSeek may be the first, but we can be sure that it won't be the last. Alibaba said this week that its model is even better than DeepSeek. Distillation is a technique that allows one AI system learning from another AI system. The distillation technique involves having an established AI model evaluate the answers coming out of a new model, effectively transferring the older model's learnings. Distillation dramatically cuts down the training time and cost of building new models. American tech monopolies have yet to start making money from their expensive investment in AI. Mark Zuckerberg made wave last year when he said that he didn't know when Meta would be able to recoup its investment. And already, the technology is at risk of being commoditized. I don't think Washington can stop this even if Trump wanted to. If the US were to somehow decide to ban access of Americans to DeepSeek, the result could be higher prices for AI services in the US than outside the US. That would be, of course, a disaster for American competitiveness. I argued in a video a month ago that I thought the AI bubble was at risk of bursting in 2025. With the DeepSeek news, I think we've seen the peak of US tech stocks. The only question now is how far down they will go and what this means for US rates and the US dollar. Everyone knows that US equity valuation is at the highest level since the dot-com bubble. If there's one lesson from the bursting of the dot-com bubble, is that a bubble of this magnitude does not burst overnight. Indeed, the dot-com bubble peaked in March 2000, and it did not find a bottom more than 2 years later. I don't know if it will be the same this time, but I think we are far from having seen the bottom. The market might have been reassured this week by the news that SoftBank is still looking to invest $25 billion into OpenAI, and that Meta has no plan to downsize its investment plan in AI yet. But I would be very surprised if the DeepSeek news does not result in a slowdown in AI, given the increased uncertainty in its future returns. This is especially so given the large language models have already run out of data to train on. I think any bounce would be short-lived. Another lesson from the bursting of the dot-com bubble is that the demand for the US dollar will suffer, even if the effect is not immediate. But the DeepSeek news is bearish for the dollar fundamentally, to the extent that the rest of the world might have just caught a big break. The dollar benefited in 2024 from the perception that the rest of the world might end up having to pay a tax to the US to access AI in the future. It looks like this will no longer be the case. If AI is going to be a game changer that its supporters say it will be to the benefit of all countries, rich and poor. As for rates, if financial conditions were to tighten as a result of lower expected returns on US equities, it would allow the Federal Reserve to cut rates more aggressively than what is priced in. I'm still of the view that in 2025, bonds will likely outperform stocks, at least on a risk-adjusted basis. Thank you for listening.